Most traders use indicators the wrong way. They rely on signals without understanding what smart money is doing behind the scenes. In this video, I'll show you 3 powerful indicators and how to combine them with smart money concepts like liquidity sweeps, key levels, and top-down analysis to find high-probability trade setups. Let's get started. The first trading indicator we'll cover is the Fibonacci Retracement tool. Take a look at this chart example. The market is in an uptrend, indicated by a strong impulsive move to the upside, followed by a pullback. Begin by drawing the Fibonacci retracement from the start of the impulsive move to its highest point. As price retraces, pay close attention to the area between the 50% and 61.8% Fibonacci levels, commonly known as the golden zone. This zone often acts as a key area where the pullback may come to an end, and the next bullish move can begin. If you prefer an aggressive entry, you can place a limit order within the golden zone without waiting for additional confirmation. However, keep in mind that this approach involves greater risk, although it also has the potential to deliver larger rewards. Take a look at this chart example. The market is clearly in a downtrend, characterized by a strong impulsive move to the downside, followed by a pullback. To draw your Fibonacci retracement, place it from the beginning of the impulsive move down to its lowest point. As price retraces, focus on the area between the 50% and 61.8% Fibonacci levels, commonly known as the golden zone. This zone often marks the end of the pullback and the beginning of a new bearish move. If you prefer a more aggressive entry, you can place a limit order within the golden zone without waiting for additional confirmation. However, keep in mind that this approach comes with greater risk, although it also offers the potential for larger rewards. Entering trades based solely on the area between the 50% and 61.8% Fibonacci levels can sometimes work, but I do not recommend using this approach on its own. Let me show you an example to explain why. In this uptrend, we see a strong impulsive move to the upside, followed by a retracement. We draw the Fibonacci retracement from the beginning of the move to its highest point and place our entry within the area between the 50% and 61.8% levels, commonly known as the golden zone. However, instead of reversing higher, the market continues to move lower, breaking through the golden zone and eventually hitting our stop loss. As a result, the trade ends in a loss. So, how can you improve the odds that the 50% or 61.8% Fibonacci levels will hold? This is where I want to introduce a powerful technique I use called the TLL method. Let's break down what the TLL method stands for. TLL stands for Trend, Level, and Liquidity Sweep Signal. For a Fibonacci retracement level to have a higher probability of holding, all 3 of these elements should be present. Let me show you a chart example. As you can see, the market is in an uptrend, characterized by impulsive moves followed by retracements. Here, we have another strong impulsive move followed by a pullback. The first step is to draw the Fibonacci retracement from the beginning of the impulsive move to its highest point. Now, if you look to the left side of the chart, you'll notice that the 50% Fibonacci level aligns perfectly with a previous resistance level that has now become support. In traditional technical analysis, broken resistance often acts as support when price revisits it. At the same time, the Fibonacci retracement strategy tells us that the 50% and 61.8% levels are common areas where pullbacks can end and trends can resume. At this stage, we already have 2 important elements in place. First, we have the trend. The market is moving higher, which tells us that buyers are in control and we are trading in the direction of the prevailing trend. Second, we have the level. A previous resistance level has turned into support, and it aligns with the 50% Fibonacci retracement level, creating a strong area of confluence. All that remains is the third element, the liquidity sweep signal. As price reaches the support area, we see a clear pin bar that briefly trades below the support level before closing back above it. This creates a liquidity sweep, indicating that stop-loss orders below support have been taken before buyers stepped back into the market. With all 3 elements aligned, trend, level, and liquidity sweep signal, we have a high probability trade setup supported by multiple confirmations. The entry is taken at the close of the pin bar, the stop loss is placed just below its low, and the target is set at the next resistance level. Now watch what happens next. Price rallies higher and reaches the target. This is the power of the TLL method. By combining trend direction, key support and resistance levels, and liquidity sweep confirmations, you can significantly improve the quality of your entries and increase the probability of successful trades. The second indicator we'll cover is RSI divergence. Divergence occurs when price action and the RSI indicator move in opposite directions. While price continues moving one way, the RSI begins telling a different story. This disagreement often serves as an early warning sign that the current trend may be losing strength and that a reversal could be approaching. There are two main types of divergence. Bullish divergence. Bullish divergence occurs when the market forms lower lows, while the RSI forms higher lows. This suggests that bearish momentum is weakening, even though price is still moving downward. As a result, the probability of an upward reversal begins to increase. Pro tip: when drawing bullish divergence, connect the lower lows using the candle bodies rather than the wicks for more accurate analysis. Bearish divergence. Bearish divergence occurs when the market forms higher highs, while the RSI forms lower highs. This indicates that bullish momentum is fading, despite price continuing to move higher. In many cases, this can signal that a downward reversal is approaching. Pro tip: when drawing bearish divergence, connect the higher highs using the candle bodies instead of the wicks. The real power of divergence comes from the RSI's ability to reveal hidden shifts in momentum that may not be obvious from price action alone. By learning to recognize these signals, you can often identify potential reversals before they become apparent to most traders. Let me show you how to trade this strategy. As you can see, the market is creating a lower low on the price chart, while the RSI indicator is forming a higher low. This is a clear bullish divergence, suggesting that bearish momentum is weakening and that the market may be preparing for an upward reversal. The next step is to wait for a candlestick pattern to confirm the setup. In this example, we have a bullish engulfing candle, showing that buyers have stepped in and gained control over sellers. This provides additional confirmation that the market could be ready to move higher. Now, let's switch to the hourly time frame. Here, the market is clearly in an uptrend. Notice how price is forming impulsive moves, followed by retracements. Since the overall market structure remains bullish, this pullback is likely to be followed by another impulsive move to the upside. This higher time frame analysis supports the bullish divergence signal we identified on the 5-minute chart and adds another layer of confirmation to the trade setup. Now let's return to the 5-minute chart. The entry can be placed at the close of the bullish engulfing candle. The stop loss should be positioned a few pips below the low of the engulfing bar. For the profit target, aim for the next resistance level while maintaining a minimum reward to risk ratio of 2:1. By combining RSI divergence, candlestick confirmation, and higher time frame trend analysis, you can significantly improve the quality of your trade entries and increase the probability of success. Now, what if you could make this strategy even more powerful? By combining RSI divergence with smart money concepts, you can significantly increase the probability of identifying successful reversal trades. Let's break this down with a real chart example. As price approaches a well-defined resistance level, it breaks above it before quickly closing back below. This is a classic liquidity sweep. In this situation, smart money pushes price beyond resistance to trigger breakout buyers and stop-loss orders before reversing the market in the opposite direction. Now, take a look at the RSI indicator. While price has formed a higher high, the RSI has created a lower high. This is a clear bearish divergence, indicating that bullish momentum is weakening even though price temporarily moved higher. At this point, we have two strong reasons to consider a selling opportunity. First, we have a key resistance level combined with a liquidity sweep, which signals that the breakout above resistance may have been a trap designed to capture liquidity. Second, we have bearish RSI divergence, providing additional evidence that the upward move is losing strength and that a reversal may be approaching. Now let's switch to the hourly time frame. As you can see, the higher time frame market structure is ranging, and price has been rejected from a supply zone. This higher time frame rejection suggests that the market may have room to move lower, supporting the bearish signal we identified on the 5-minute chart. With the higher time frame aligned, let's return to the 5-minute chart and plan the trade. The entry is placed at the close of the candle that closes back below the resistance level. The stop loss is positioned just above the high of the liquidity sweep candle. For the profit target, aim for the next support level while maintaining a minimum reward to risk ratio of 2:1. By combining a key resistance level, a liquidity sweep, RSI divergence, and higher time frame confirmation, you create a powerful confluence-based setup that can significantly improve the quality of your reversal trades. Now let's look at the MACD indicator. Take a look at this euro against the US dollar 5-minute chart. The market reaches a price level and reverses, creating a clear resistance zone. Later, price returns to the same area and rejects it once again, confirming the strength of that resistance level. Now, as the market approaches the resistance for a third time, price breaks above it before quickly reversing and closing back below the level. So, what do we have here? This is a classic liquidity sweep. Smart money pushed price above resistance to trigger stop-loss orders from sellers and attract breakout buyers into the market. Once enough liquidity was collected, the market reversed sharply lower, trapping traders who expected a bullish breakout. With the liquidity sweep identified, we now have a strong indication that the market may be preparing for a bearish move. Next, let's check the MACD indicator. Notice how the MACD line crosses below the signal line. This crossover generates a bearish signal, suggesting that downside momentum may be building. At this stage, we have two important confirmations: a liquidity sweep, signaling potential bearish intent; a MACD crossover, supporting a short trade opportunity. Entry: place a sell order at the close of the bearish candle that forms after the liquidity sweep. Stop loss: position the stop loss slightly above the resistance level to allow for normal market fluctuations. Target: aim for the next support level while maintaining a minimum reward to risk ratio of 2:1. Now watch what happens next. The market moves lower exactly as anticipated and reaches the target, resulting in a successful trade. This example highlights the power of combining liquidity sweeps, MACD confirmation, and top-down analysis. When all three factors align, you can dramatically improve the quality of your setups and focus on trades with a higher probability of success. If you enjoyed this video, don't forget to like, subscribe, and hit the notification bell so you get notified whenever a new video is released. Thanks for watching, and I'll see you in the next video.